Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LevFin Insights Levered Line Podcast. I'm Steve Miller, a member of the CreditSights team here at Fitch Solutions. Today we're talking to Bob Post, who runs the U.S. CLO business at Blackstone. Blackstone, of course, is one of the largest CLO managers with $47 billion of AUM globally. Before joining Blackstone a decade ago, Bob held various positions in leveraged finance at BlackRock, BMO, and MetLife. Bob's also a proud New Jersey resident and a valued friend of the family here at Fitch. Bob, thanks for joining us today.
Thanks, Steve, for having me.
Of course. So let's start with the table setter. Let's talk about your business and how you aspire to grow it.
You alluded to it, but we have around $35 billion of CLO AUM in the U.S. We have $15 billion in Europe. So together, that makes us the largest CLO manager globally and also the largest manager in the U.S. If you think about how that has sort of come about, you rewind 8 to 10 years, we were around 15, 16 billion in size in the U.S. We did 3 to 5 deals a year. And our primary equity source was our risk retention fund, which, if you remember, in the market was very topical in those years in both Europe and the US. You fast forward a few years and risk retention basically fell away in the US, but remained very much in Europe. And so that fund that we raised for risk retention purposes pivoted more to service our European business, which then created this additional capacity in the US to work again more with our third-party equity investors who we've worked with for a long time and are typically repeat multi-deal types of investors. So that was really the sort of dynamic that fueled our growth from coming out of COVID until today. The next evolution of our equity capital base now is what we've done more partnering with Blackstone, where we've actually gone to some of our firm's largest LPs, and we've brought the CLO equity product to them to complement some of the other strategies they're already invested with at Blackstone. And so I think that's going to fuel sort of the next stage of our growth. And then the last thing I would say is more around the products. So we're talking about CLOs, which we've done for 25 plus years. It's been our sort of the lifeblood of our business. Going back to the very beginning. But there's also sort of products that tangent off of CLOs that we've done from time to time that we're thinking very seriously about doing more of. One is a CBO, which we did one in 2017. But we think the CBO is actually a really interesting opportunity. We have a really good bond business, a systematic bond business that we acquired in 2020. They've had tremendous performance. They're great at managing assets. You couple that with our sort of structuring expertise in all things structured credit, and it just makes so much sense to us that we should have a CBO business that's more of a programmatic type of issuer when you combine those two pieces. The second product that we've done more of is a static. We've done static CLOs at various points over the last few years, really coming out of COVID. Either pull-to-par trades when the market's dislocated, which in many ways has been some of our best returning vehicles, and also this more IO trade where the market's at par, but we think sort of the outlook is generally pretty stable. You lever it a bit more than a CLO. Your cost of capital is a little more optimized, and you can really squeeze the juice out of the arbitrage. That's also been a really good trade. And so I think bringing static deals or the option of static deals as a complement to existing CLOs and our existing CLO investors is also something that we want to bring more of.
Interesting. And very just as a follow-up, when we think about actively managed CLO with a 2-year, 5-year structure, whatever it is, versus a static deal, how do you think about that as far as, how the investors would approach that? What kind of investors would be interested more in a static deal versus an active deal?
It's a good question. There's some investors that like a shorter time frame. There's some investors that like a shorter non-call, right? If the market, if liabilities are priced a certain way. So those sort of factors come into it. On the portfolio side, though, they do look a bit different. And a static portfolio for us is generally the highest quality portfolio that we put together because your ability to sell mistakes and replace them isn't really there. So you want to try and keep the portfolio as levered and as intact as possible. Versus our other deals where you have the flexibility to trade, and swap into better risk as risk changes.
Very interesting. Okay, it'll be interesting to follow that. So we talked about this a little bit before we got started. The stock market has been incredibly resilient this year. It certainly surprised me. We've been living through some interesting times here in 2026. I wonder if you can talk about how you read the market conditions in the BSL market today, and particularly drilling down on what it might mean for M&A activity.
Yeah, so the loan market today, I would say, has its share of challenges, right? And the key word I would use to describe loans today is bifurcation. And that's been a theme that we've seen really since 2022, when I think risk sentiment changed to where investors were sort of gravitating towards performing risk and shying away very much from underperforming risk. So we've been living with that dynamic for multiple years, but it's as pronounced, I would say, today as it's ever been. And that makes it very hard, right? That makes it hard when, let's call it 2/3 of the market that's performing well is basically at par, has had, by some measures, unprecedented levels of repricing over the last couple of years. So it's getting tighter and tighter.
Yes.
That group of names is getting smaller and smaller, and you have more and more of the market chasing that
Yes.
subset. You contrast that with the other third of the market that, to varying degrees, has sort of some sort of credit or underperforming issue, which will dictate how much below par it trades. But the sort of investor approach to that part of the market has stayed the same, in that it's basically the opposite dynamic of what I described with the other group. Risk sentiment around that part of the market is very, very difficult. There isn't a lot of tolerance for underperformance. I think investors are very wary of participating in situations that have more and more likelihood of going down some sort of LME transaction. And if you think about documentation in a market, which I'm sure we'll get into, it's been loose for years, right?
Yes.
And the thing that has changed really coming out of COVID is the sponsor's willingness to use it,
Yes.
right? It's generally been there, but now there's sort of an axe to use it. And so our base case in these situations basically is you have to have the understanding, or sort of have the mindset, that this is going to be the base outcome, is some sort of LME, and you have to be sort of positioned that way and trading it that way. In terms of supply, I think this year was finally going to be the year that we had a lot of growth in our market, right?
Yeah.
Growth has been a bit constrained in the loan market for multiple years now. I think people forget that the market actually shrunk in 2023 and 2024. It grew a little bit last year, and it was supposed to grow even more this year. I think, unfortunately, for various reasons, right, the conflict in the Middle East, you have the AI software volatility that sort of had the market take a step back in terms of risk tolerance. All of that has led to sort of a slowdown in deal-making activity. We are hearing that as this has sort of played through a bit for the last few months, that the banks and the sponsors are getting a bit more active. But I don't think that the level of primary activity for this year is going to be what everyone had sort of hoped and thought just a few months ago. So maybe 2027 is our year.
That's a great point. And I wonder if I could just ask a quick follow-up. So what does that mean, do you think, for CLO issuance? Obviously, April, the way we track the numbers, was a very down month. I think the lowest month we'd had in 2 or 3 years. And is that just a blip because of all the volatility a little early in the year, or do you think that's because we're just not seeing the growth in the space?
I think it's a little of both. The volatility in our market has changed structurally, right? If you go back, multiple years, we had more volatility, it feels like, in loans, right? The drawdowns were a little bit deeper, and the periods of volatility felt longer than they are sort of in the last few years, right?
That's fair, yep.
Think about today, like Liberation Day was a good example, where that was like the last, I would say, real technical dislocation where there was selling pressure across the market. So you could buy performing non-tariff at-risk types of names lower. But the extent to which you could buy them lower was maybe 2 points or 3 points at the very lows. And that time period lasted, we like to joke, like maybe an afternoon. Right? And so it speaks really, I think, to the proliferation and sort of proven out of the CLO asset class, right? Like, the market has done an excellent job of creating CLOs over the last 5-10 years. And CLOs are locked up capital that have a warehousing dynamic at the beginning where you want to be buyers of that volatility. CLO structures are excellent to invest in technical volatility. And so with 2/3 to 70% of the market today being CLOs, you're not getting that selling pressure the way that you used to.
Yeah, that's interesting. So let's switch gears slightly and talk about the new issue market, and particularly this fluid frontier between private credit and BSL. I like to think of the market this year starting on a blaze of fire, kind of like the Yankees pitching staff, right? And then we had the disruption, obviously, in March. Spreads in the way we track the numbers spiked to 5-6 year highs. And then have come down, 75, 100 basis points since then. How do you scale that, and how do you think it plays in with what's going on in private credit and the competitive dynamics between the two spaces?
Yeah, so I think the two markets have come to sort of an equilibrium, right? I think at the beginning, as private credit was ramping up a lot over the last couple of years, lots of investors that we spoke with were sort of thinking about it as if one was going to come at the expense of the other. And I think the
Yes.
reality is they both complement each other really well. There's things that the BSL market does well that the private credit market is less apt to do, and vice versa, right? Private capital is more flexible. So if you're a borrower that's looking for that, then you can go to that market as a sort of other option. Today, what you're seeing in both markets is starting to diverge a bit, right? Private credit has been in the headlines a lot. There's a flow change in there in terms of the retail component to private credit. So I think going forward, the capital deployment needs of private credit are not what they have been for the last couple of years. So I think directionally that means that private credit spreads are going a bit wider. And we've already seen them widen a bit off of the lows that they hit late last year.
Yeah.
BSL land, on the other hand, we're definitely a little bit wider than we were last year for generic performing new issue BSLs, but we're not that much wider. And I think, again, to the point before, there's just so much demand for performing assets from the BSL market that I think the spread differential, I think the competitiveness or the attractiveness from a cost point of view is incrementally getting a bit better for BSLs versus private credit. So if you're a borrower that's sort of in the middle where you're more able to focus on economics versus flexibility or certainty of execution in private credit, maybe that steers on the margin a few more credits in our market's direction, which would be great because that would lead to a bit more growth.
And you would think some of these private credits have had time to season. They've improved in performance. A lot of the statistics, despite all of the worries about what the future holds, have been good, at least in the rearview mirror. There'd be some very good candidates come out of private credit and come to BSL. I'm sure you guys are on that.
We are. We are, and I think a lot of the banks are. But yeah, that's a tremendous source of, creating your own deals, so to speak, is looking through the private credit universe, saying what's performing well, what can now focus more on their cost of capital versus maybe a different reason when they first came to market, to your point. But yeah, that's a really interesting source of deal flow, I think.
So let's switch gears again. Let's talk a little about credit fundamentals. I alluded to some of the numbers we've been tracking showing the rearview mirror pretty good. How do you kind of scale the forward view?
Yeah, so fundamentals are definitely resilient, I would say. I mean, in the face of everything going on in the world, the one thing that has held up consistently have been fundamentals, and we see it across our portfolio, across really the whole firm. In the U.S. and in Europe, the growth is a bit stronger in the U.S. and Europe, but from a credit perspective, both are definitely resilient for sure. And we expect that to continue going forward.
Now, you mentioned before about the AI disruption trade, and obviously that's been a great theme, great not in the sense that it's good, but in the sense that it's large this year. How do you see the AI theme playing out? I mean, software, I guess, had caught a decline and now has bounced back slightly. And are there other sectors that you feel like could be in the crosshairs there?
Yeah, so I think a lot of people use software as their proxy to express AI. In the loan market, it's broader than software. Software is a big part of our market. It's between 12 and 15%, depending on how you look at it. But the other areas of our market that are also sort of exposed to AI, we'll call it, include other parts of technology, include education technology, include healthcare IT, and include business services. So if you sum it all up, it's almost a third of our market, give or take, that is in some ways exposed to AI. AI, I think, as a concept, as a risk, is a really hard sort of dynamic to get your head around as an investor, especially in our market. And it's something that's going to play out, we think, over years, not necessarily months or quarters, the way some of, I think, loan prices have reacted. So it's a challenging concept. It's a risk that's going to happen some point in the future. And then the performance today of the vast majority of these companies is actually very good. And in many cases, better than the average performance of companies in our portfolio. So it's this difficult concept that investors are going to have to grapple with around how do you think about credit value to something that's performing well today, cash flowing today, and it has some sort of hard to conceptualize risk that may happen in the future. And so I think, we're going to go through sort of fits and starts around sort of AI related sentiment for our market, and I think broadly. And it's really going to come down, we think, to like the details, right? Like the type of solution that it is, how embedded they are, whether they have the balance sheet and the financial flexibility to invest in AI and pivot their existing businesses more in that direction, whether they have a sponsor and a management team that are willing and able to do that.
Yes,
So I
critical.
think a lot of sort of components come into this beyond just what sort of subsector does the company live in the software space or the tech space in general. And it's going to be, I think, a pretty long, drawn-out process before the market finally sort of has come to a consensus around how to think about it.
Yeah, all great points. So you talked a bit about how the results from the companies have been good and been stronger than maybe expected. We've got this AI issue that is in the vague future, but maybe not affecting things today. And if you kind of add it all up in your mind, how do you think that impacts a default rate? The way Fitch Ratings tracks defaults, it's fallen slightly this year. I think it ended last year at 5.1%. Now we're at 4.8%. And just to break it down a little more finely, of that 4.8%, roughly 3.8 percentage points is in the distressed exchange LMT, which also is wrapped up in there. So if you look out, call it the next 12 months, do you think the trend will be higher defaults, neutral, lower, and do you have kind of a bull or a bear case in mind as you think?
Yeah, I mean, I think the default rate, today is generally pretty low, right, from a pure default perspective. I think going forward, we expect the default rate to rise off of what are below average levels. If you look at the barometers that the market is giving you in terms of what future defaults are going to be, the sub 80 portion of our market today is around 5%. When you throw into the 80 to 90 bucket, it's another 5%. So say 10% of the market trades below 90. Yeah. So if you think about those companies are sort of the prime candidates of default that could default over the coming sort of 1 to 3 years. And then you spread that out over that time. It's hard to get to that different of a default rate than we've seen, right? Maybe 2, 3, 3.5%, something like that. And then you throw in the sort of LME dynamic, right? The SDs and how that factors in. And that I think is much harder to predict because it's a bit more episodic or opportunistic from the sponsors. But you throw that in and it's probably another little bit of a layer on top of that. So trajectory-wise, I think we're higher, but not, massively higher, not a step change higher.
Interesting. So alongside that is the issue of recoveries, right? So when I was young, which seems like a long time ago now, in the loan market, people would model 2% default rates, 80% recovery rates. A lot of the statistics have come out lately have been much lower on the recovery scale. I wonder how you think about recoveries as you model new deals and vehicles.
Yeah, so this is a great topic. So definitely, I think recoveries are not what they used to be. To your point, right? Document flexibility over the years that is basically universal at this point in our market, and then importantly, especially over the last couple of years, sponsors' willingness to use it has definitely been a shift. So the base case today for us is something that's underperforming, to a certain extent. Or past a certain threshold, like our base case is that an LME is the eventual outcome. So that's just the mindset that you have to have going into these situations. As far as recoveries go, though, it gets a little bit more murky from there. Right now, you're having situations where you actually have different recoveries for creditors in the same part of a capital structure. So that adds a level of sort of complexity to this. And I also think some investors will say, they've looked at the rolling 12-month recoveries at various points over the last few years, and at points they've been very, very low, as you know. And I don't know that it's doing, us the best service by saying, oh yeah, I think recoveries used to be 80 and now they're whatever some LTM low has been. I think the reality is like going forward, it's somewhere in the middle, right? They're structurally lower than they were before because of documents and the sponsors' willingness to sort of use that flexibility. But if you think about the companies that have defaulted over the last couple of years that are in that recovery data, we haven't actually gone through a credit cycle in a very long time. So for a company to be defaulting over that time period means there's something going wrong with the business. Right? It's not like a macro cyclical dynamic where you're going down and eventually you recover. Recoveries in those types of situations tend to be better than the situation where a business is just defaulting because it has a business issue or the level of competition, something has changed with its ability to compete. That is a much harder situation to course correct. And so recoveries tend to be lower anyway versus the classic cyclical default. So I think there's two sides to it. And eventually I think we're going to get to somewhere in the middle.
That's such a really excellent point and something I guess I hadn't thought about in a while. Back again, when I was young, you'd have the bad balance sheet defaults and the bad business defaults. I guess what you're saying is these days we really only get the bad business defaults coming through for obvious reasons. So let's talk a bit about LMTs in the sense of when you've seen these exercises go through, do you find that they just postpone the issue and move the economics around, or they actually can lead to a better outcome for everybody?
Mostly, we've seen, and I think the data shows that for the most part, these LMT transactions do not fix the problem, right? At the end of the day, you actually need the business to inflect and to fix itself and to perform better for there to be value for any of the stakeholders, right? From first lien down to equity. And for the most part, to my comment before about investors not really being rewarded for taking risk in recent years, there haven't been a lot of scenarios or situations where you've actually seen a company successfully turn itself around and course correct.
Yes.
And so I think LMTs are sort of a delay, right? They often involve getting liquidity. If the company's burning liquidity, or sometimes even if they're not, they get liquidity, usually from lenders. It sometimes involves a maturity extension. It sometimes involves discount where you're reducing the debt load, which can help give the company a bit more time. But eventually, the day of reckoning has usually come for these companies, and most of them have ended up defaulting again.
Interesting. So let's talk about tradecraft, right? This is one of my favorite topics to cover with folks when we do these interviews, and how you guys are using AI in your business to make efficiencies happen, to improve your process, that kind of thing. I think people are very interested in that.
Yeah, so I think first and foremost, it's very early days around all of this. At Blackstone, we've been spending a lot of time and a lot of resources trying to be as front-footed around this as possible, but I think it's still early days. If I think about how we're using it now, I think first and foremost, it's been driving efficiency, right? So it's led to people being more productive, whether it's creating credit memos that go through our various investment committees, whether it's been receiving those memos and digesting them and distilling them down into the important parts. That's driven productivity and efficiency. And I think over time, and there's tons of people working at this at the firm, over time, what it's going to do is help us sort of leverage all the data that we have right across our $1.3 trillion portfolio across the firm. There's tons of data in there from all different parts of the market and parts of the world. And so if AI can help us make that data more insightful and then help us turn those insights into better, quicker investment decisions on the front end, I think that will be very, very powerful.
That's exciting. Yeah. And so along with that, if we have some young people listening to this podcast, what recommendations would you make to them for the skills they ought to acquire to work at Blackstone or one of the firms today?
Yeah. A couple things. One, I would say try and get as diverse an experience set as possible, right? Try new things, be open to new things. Within asset management or certainly finance in general, there are so many different jobs that highlight different skills and strengths. And so I think having a diverse sort of sample set to see and choose from when you eventually find sort of the thing that you want to traject your career towards is really important. Two, I think you have to always stay curious and ask why, right? With how fast the world is changing today, staying on top of that and not taking what used to be true yesterday as true tomorrow, I think is a really important mindset. And then we talk about AI and what AI is going to do for sort of like the workforce. My third thing would be judgment. And I think judgment is something that I've seen over my career. The more senior you go in an organization, to me, the one constant is judgment from those types of people is exceptional. And I think that the risk is as you have AI come online that makes certain processes or tasks easier or automated, you could have a generation of people that are coming into the workforce who sort of don't understand as well the concepts behind it because AI can just make that financial model or give me a list of questions to ask this company on this earnings call. And unless you really understand how these concepts work and interplay, then it's hard to then learn how to have the right judgment to then take what AI is giving you and make the right decision.
And I would imagine it's a little bit of a art to say to people, well, we want you to be more efficient, so use Claude or ChatGPT or whatever to summarize the earnings call and really get into it, versus there might be some subtlety in question, X on page Y that you might miss doing that.
Exactly.
Very interesting. Let's leave it there. Thanks, Bob, for your time today and your insights. Thanks to our listeners for joining us. Please catch us next time for the next episode of LevFin Insights Levered Line Podcast.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.